In the shadows of Wall Street, there's a world you rarely see, a world of immense power and staggering wealth. In this world, unseen forces are at play, moving trillions of dollars with the stroke of a pen. But this isn't just about numbers on a screen. This is about your future, your retirement, your life's savings. Today, we're pulling back the curtain on a hidden operation, a story of high-stakes finance and immense risk. We're going to talk about the creatures that thrive in these shadows, the liquidity vampires. They don't have fangs, and they don't fear the sunlight. They wear expensive suits and carry briefcases, and their thirst is for something far more valuable than blood. They crave liquidity, the lifeblood of our economy, and specifically, the lifeblood of your pension. Imagine a vast, serene lake. This lake is the culmination of a lifetime of work for millions of people. It's the pension fund system, trillions of dollars set aside for teachers, firefighters, factory workers, and countless others. It represents the promise of a secure retirement, a dream of peace and stability after decades of labor. This quiet, enormous pool of money is supposed to be managed conservatively, protected at all costs. But its sheer size makes it an irresistible target. For the liquidity vampires of the financial world, this isn't a sacred trust. It's a hunting ground, and they've perfected a method to tap into it. The hunt begins not with a chase, but with a courtship. Private equity firms, the modern-day aristocrats of Wall Street, approach the managers of these pension funds. They come bearing gifts not of gold, but of promises. They promise market-beating returns, access to exclusive deals, and a level of sophistication that seems to dwarf the slow and steady world of public stocks and bonds. They paint a picture of a world where returns are not just good, but extraordinary. To fund managers under pressure to meet their obligations to future retirees, this siren song can be incredibly difficult to resist. They see a chance to boost their fund's performance to secure the future for their members. So, they agree. They commit hundreds of millions, sometimes billions, of their pensioners' dollars to these private equity funds, entrusting them with a piece of everyone's future. Once the capital is secured, the vampires unleash their preferred weapon, the leveraged buyout, or LBO. It's a strategy as brutal as it is brilliant. Here's how it works. A private equity firm identifies a target, a stable, profitable, and often well-known company. Let's say this company is worth $1 billion. The private equity firm doesn't use its own money to buy it. Oh no, that would be too risky. Instead, they use the money they've raised from pension funds and others for a small down payment, say $200 million. And the rest, the other $800 million, they borrow it. But here's the truly audacious part. They don't take on the debt themselves. The debt is placed directly onto the books of the company they are acquiring. In essence, the company is forced to buy itself with borrowed money. It's like buying a house with a small down payment and then having the house itself be responsible for the mortgage. The private equity firm gets control of $1 billion asset for a fraction of the cost. The deal is done. The trap is set. Now, the feeding begins. The newly acquired company, once healthy and profitable, is now gasping for air under a mountain of new debt. Its cash flow, which used to be reinvested into research, expansion, or employee benefits, is now redirected to service this enormous debt load. The private equity owners, the liquidity vampires, begin their work. They are masters of extraction. They start by charging the company exorbitant management fees, transaction fees, and advisory fees. These fees can run into the tens of millions of dollars every year, flowing directly into the pockets of the private equity firm, regardless of whether the company is succeeding or failing. Next, they strip the assets. The company might own valuable real estate, it's sold off. The cash isn't reinvested, it's paid out to the private equity owners as a special dividend. They might slash the research and development budget, sacrificing the company's long-term future for short-term cash. They lay off workers to cut costs, further boosting cash flow that can be extracted. Every move is designed to drain the company of its liquidity, its financial lifeblood. The very essence of the company is being siphoned away, piece by piece, to repay the debt it was forced to take on and to generate massive profits for its new owners. The company becomes a shell. Its sole purpose now is to serve the financial needs of its vampire masters. And what about the pension fund, the original source of the capital? They are now trapped. Private equity investments are notoriously illiquid. Unlike a stock you can sell any day, this money is locked up for 10 years or more. Throughout this period, the reporting they receive is opaque and often self-serving. The private equity firm values its own portfolio, leading to a practice known as performance smoothing. The stated returns can look fantastic on paper, even when the underlying company is struggling. The true performance is masked behind complex accounting and delayed reporting. The pension fund managers are told everything is going according to plan, that the superior returns are just around the corner. But the risk has been quietly transferred. The private equity firm took its fees and special dividends up front, guaranteeing its profit. The immense risk created by the massive debt that now sits squarely on the shoulders of the company, and by extension, on the pension fund that owns it. If the company fails, it's the retirees who will ultimately bear the loss. Sooner or later, the aftermath becomes clear. After 5 to 7 years of being drained, the private equity firm looks for an exit. Sometimes, they manage to sell the hollowed-out company to another buyer, often by dressing it up to look healthier than it is. Sometimes, they take it public again in an IPO. In these best-case scenarios for the firm, they walk away with profits that can be hundreds of times their initial investment. But often, the company, crippled by debt and stripped of its assets, simply collapses. It files for bankruptcy. Thousands of jobs are lost. A once great business is gone forever. And the pension fund, it's left holding a worthless investment. The superior returns they were promised evaporate, replaced by a permanent loss of capital. The money meant for a teacher's retirement, a firefighter's security, has vanished, consumed to fuel a few years of extravagant profits for the liquidity vampires. They take no responsibility. They've already moved on, seeking their next victim, their next pool of quiet money to drain. This isn't a fictional horror story. This is the reality of a significant part of the modern financial system. The names of the firms are well known on Wall Street, and the companies they've bought and loaded with debt are often household names. The vampires are real, and they operate in plain sight, protected by complexity and a system that rewards extraction over creation. They are feeding on our collective future, draining the pensions that are the bedrock of retirement for millions. It's a silent crisis unfolding in the spreadsheets and boardrooms, far from public view, but its consequences are very, very real. The first step to fighting back is awareness. We have to understand how the hunt works, how the weapon is used, and how our future is being put at risk. Because if we don't, the liquidity vampires will continue to feed, and the promise of a secure retirement will become just that, a promise, drained of its substance. Thanks for watching. If you found this informative, please share it and subscribe for more deep dives into the stories that shape our world.